What's up guys? Welcome back to Money Crow, the channel all about making your money grow. Today I'll be revealing my $100,000 portfolio in the very first installment of my Wheel Portfolio series. I will also be teaching you everything you need to know about the Wheel option selling strategy. It's my absolute favorite way to grow my money, and I want to teach it to you so you can use this knowledge to grow your money as well. Sadly, this initial reveal will be rather underwhelming because Webull takes up to 5 business days to process deposits. However, I've decided to sell a put on Wells Fargo using another one of my accounts so that I could have a real example in this video of a trade that I made. I'll go more into that later. In my next video, I should have full access to all my funds and I'll start showing you this strategy in action with some larger trades. Before we get started, here's a quick shout out to my Patreon supporters. Thank you so much to Prismatic and Erica for supporting me through Patreon as level 12 Crow investors. You are the backbone of this channel and I hope you're getting a ton of value from my real-time Wheel Portfolio updates. If you want to be notified immediately after I make a trade, consider supporting me on Patreon. I'll have all that information listed on there, linked down below. In my description, I have 3 different referral links that will make your money grow. Click my Webull link to get a free stock valued up to $1,600 when you sign up and fund your account with $100. Click my M1 Finance link to get $20 cash when you sign up and deposit $100. And click my Robinhood link to get a free stock like Apple or Facebook when you sign up. So what exactly is the Wheel option selling strategy? It can be summarized as the continuous option selling strategy. You may be interested in trying out the strategy for yourself, or maybe you just want to see it in action. If you don't understand call and put options, I would highly recommend watching my previous video, which explains calls and puts in very simple terms. Link in the description. If the information in my video helps you, I would really appreciate it if you like the video and subscribe to my channel. Now, back to the wheel. Is that too aggressive? And now, back to the wheel. Okay, we have 2 takes. I have a stack of cash sitting in my brokerage account that I'd like to invest in stocks. But in my opinion, the stocks I want to buy are a bit overvalued right now. If only there was a way to get paid now in order to buy stocks in the future at a price I feel comfortable buying at. Does that sound too good to be true? It's not. That's exactly what happens when you sell a put option. When you sell a put, you're choosing the stock you like at a price you like with an expiration date that you like, and you get paid for selling it. So why isn't everyone doing this? All you need in order to sell a put is enough cash in your account to buy 100 shares of stock at the strike price that you choose. So let me explain all of that in simple terms with a real life example. Remember how I said I sold a put on Wells Fargo? I literally did that about 30 minutes ago before I started filming this video. And I immediately posted my trade on Patreon for my supporters. So this is exactly the trade that I made. As of the filming of this video, which is September 10th, 2020, Wells Fargo is trading at $24.48 per share. To me personally, their stock price is actually valued at a very decent price that I would like to buy at. But I would love to buy the stock if it were even lower. If I could buy it at $21 per share, I would be getting a 14.21% discount from the current share price. That sounds like a great deal to me. That sounds like a great deal to me. I don't know, one of those. Here is the real life put option that I sold earlier today for 40 cents per share. And remember, one options contract is 100 shares, so 40 cents times 100 means I got $40 in premium. By selling that put, you're giving someone else the option to sell you 100 shares of Wells Fargo on or before October 23rd, 2020 at $21 per share. Remember how I would be fine buying shares today at the going market price of $24.48? I would be ecstatic to buy them at $21. Even if the stock drops below $21, I'm 100% fine buying at $21 and holding the stock. since I'm long-term bullish on the company. In case you're new to stock market slang, being bullish means you think the stock will go up. So what are the requirements to sell that put, and why is it so beneficial to do so? Remember how I said earlier, the only thing you need in order to sell a put option is the cash in your account in order to buy 100 shares at the strike price that you choose? In our example, we would need $21 times 100, which equals $2,100 in cash to put up as collateral in order to sell the put. I'm going to go over some statistics as to why this trade is attractive to me and why I did it. So our downside buffer, as I like to call it, is minus 14.21%, because Wells Fargo needs to drop at least that much for us to be at risk of being assigned to purchase the 100 shares. For a blue chip stock like Wells Fargo, with an expiration date that far away, that's not bad at all. Again, if you're new to stock market slang, blue chip means we're talking about a high quality company with a proven track record. And remember, I would be happy to own Wells Fargo, especially at $21 per share, which is also very important. Always make sure you're okay owning any stock you sell a put on, and always make sure you're happy with the stock price that you choose. Our annualized rate of return from selling this put option is a whopping 16.16%, which I consider amazing because the average rate of return for something like the S&P 500 index fund is 10% annualized. So this is a very respectable return. That annualized rate of return is calculated as follows. We have 40 cents per share times 100 shares. That equals $40 total premium received. Actually, we might be putting the text that way. $40 premium divided by 43 days left until our expiration date means we're technically receiving 93 cents of premium per day, and we do 93 cents per day times 365 days to get the annualized rate. So we could technically receive $339.45 premium if this contract was somehow 365 days long, which it's not, but that's how we calculate the annualized rate. So now we take that $339, so I need to stop pointing up. I just won't point. So now we take that $339.45 premium and divide it by the cash collateral required to sell the put, which for this put was $2,100. And that equals 0.1616. And we multiply that by 100 to represent it as an annualized percent, which would be 16.16%. So that's how we calculate the annualized rate of return. Plus 16.16% is what you would make annualized by selling this put option. Now, because I sold that put option, a few things can happen. Here are the most straightforward scenarios. Number one, Wells Fargo goes up in price from now until our expiration, October 23rd, 2020, rising well above its current share price of $24.48 per share. And in this case, we're not assigned to purchase the 100 shares at $21 each. But we still keep our $40 in premium. We missed out on some gains we could have had by simply buying shares outright, but we took on less risk than just buying those shares, and we still got paid a premium. Number two, Wells Fargo goes down in price from now until October 23rd, 2020, and at one point it falls below our strike price of $21 per share, and we are assigned to purchase 100 shares at $21 each. We also get to keep our $40 premium. Again, make sure you are happy owning the company at the strike price you choose. If you do so, this will be a positive event if it happens. And number three, Wells Fargo trades sideways but ends up at above $21 per share from now until October 23rd, 2020. So we are not assigned to purchase 100 shares at $21 per share. we also get to keep our $40 premium. In my head, all three of those scenarios are wins. Either you profit by Wells Fargo staying above your strike price, or you get what you wanted and you get to scoop up cheap shares of Wells Fargo. No matter what happens, you still get to keep that $40 premium that made you an annualized return of 16.16% on your collateral. That's why selling puts is such a great strategy, and it's step number 1 of the wheel strategy. I know I said this is my favorite strategy, but it's important to understand that all investments come with risk. In the case of the wheel portfolio, when you sell a put, you're technically risking all of your cash collateral that you use for your trade, because the underlying stock, which in my example was Wells Fargo, could technically fall all the way down to $0, and you would still be obligated to buy them at your strike price. Please keep that in mind when you're selling options. I hope you guys learned all the basics of selling puts, which is step 1 of the wheel option selling strategy. And in my next video, we'll be covering what happens if we get assigned on our puts and are obligated to buy 100 shares of Wells Fargo. Here's a hint. We now get to sell calls using those 100 shares as collateral in order to continue the wheel strategy. If you want to follow all of my trades in real time, please consider supporting me on Patreon, and remember to get your free stocks also in the description down below. Thank you guys so much for watching until the very end. I hope you'll be back for future videos, and as always, please subscribe, hit the notification bell, like, and comment. Have a great day, and I'll see you next time.